Okay, I see someone is asking about the SAGE practicals from second year. We have been discussing doing another program called Zero or Xerox. It's spelled Xerox. So that'll be communicated about shortly. It's an advanced program to Sage, so it's actually a better program than Sage. Okay, so that'll be communicated shortly. So just have a look at that. Okay, students, let's start this lecture. So last time you would have you would have started looking at the introduction of groups. This week we're going to be carrying on with groups, and we're going to specifically be looking at acquiring a wholly owned subsidiary. Okay, so a company can acquire a wholly owned subsidiary, or it can acquire partial ownership of a subsidiary. In this lecture, we'll be looking at wholly owned subsidiaries and how to account for that in consolidations. Next, the next lecture, which will be after the mid-semester break, that will be looking at how to account for a partially owned acquisition. Okay, but this lecture will be looking at wholly owned acquisitions, which is a lot more basic, and this will set the foundation for the following week's lectures. Okay, so this is lecture 2 of 5 weeks of groups. It is under Unit 5 on Blackboard. So what are our learning objectives here for this week in particular? So we're going to be looking at what is the purchase or acquisition method. We are then going to look at steps in the purchase method to a business combination. So there are certain steps I'm going to teach you, which if you learn those steps and apply it, you should be able to understand this section and earn marks when you do your assessment. We are going to be preparing an analysis of owner's equity in a subsidiary at acquisition for 100% owned subsidiary. So that is a wholly owned subsidiary. Then we're going to be preparing pro forma consolidation journal entries at acquisition relating to the following. So we're going to be eliminating the investment in the subsidiary in the records of the parent company against the equity of the subsidiary. Okay, that sounds complicated, but we have a few examples in the slides that are going to explain this nicely. Then we're going to look at the elimination of common items in the parent and the subsidiary. So often what happens, there could be a loan from the parent to the subsidiary, meaning it's a related party transaction. And on consolidation, this will need to be adjusted. Then we're going to be looking at the pro forma consolidation journal entries relating to the following. So we're going to be recording the purchase difference. So where the consideration is greater than the fair value of the net assets acquired, we have a situation where goodwill is created. We are going to be learning about what is goodwill and how should it be accounted for in the consolidation process. Then on the other hand, which is the opposite from where there is goodwill, there can be a gain on bargain purchase. So this would happen where the consideration paid is less than the fair value of the net assets acquired. Okay, then we are going to be preparing and presenting the consolidated financial statements at acquisition for a wholly owned subsidiary. We are going to be doing this in terms of Section 9 of IFRS for SMEs, Section 9 and Section 19. And then we're also going to be doing this while considering the Companies Act. Okay, so those are our learning objectives. It sounds complicated, but as we go through it, you will see that when we do the examples and break it down, it's not too complicated at this level, but the next lecture will get a bit more complicated. So let's have a look where our sources of information are going to come from. Sorry, I'm just trying to fix something on my laptop. Okay. So we're going to be looking at IFRS for SMEs, like I've mentioned previously. These are the different sections you can have a look at in your own time. There's section 1, section 3, section 9, section 19. Okay, so you need to look at all of these sections, and then in the textbook, Understanding IFRS for SMEs, it's in chapter 20, and it is called Consolidated and Separate Financial Statements. Okay, so have a look at that in your textbooks. In addition to these slides, okay. So let's carry on to the actual content of this lecture. So what are the steps in a purchase or acquisition method, okay? So there are various steps that we are going to follow. So the first thing you need to do is that you need to identify who the acquirer is. So in a purchase or acquisition, you're going to have an acquirer, which is known as the parent company, and then you're also going to have an acquiree, which is the subsidiary. So the first thing you need to do is to identify who is the acquirer, who is the parent. This will often be told to you in the question. It will say P Limited bought S Limited. Okay, so in that case, you would be able to identify who is the acquiring company, and they are known as the parent. Then we need to determine the acquisition date. Okay, what date is this acquisition happening, as this will be important when processing your journal entries. Then the next step is to allocate at acquisition date the cost of the business combination to the assets acquired and the liabilities and provisions for contingent liabilities assumed. So basically, we need to allocate how much is being paid for this business and what is being given for this, what is being given. So we basically need to allocate the cost of the business combination to the assets and liabilities and everything else. So this is known as the fair value of the net assets acquired. So the acquirer, parent company, is giving something to acquire the fair value of the net assets, okay? Or they're acquiring the net assets, which have to be measured at fair value on acquisition date. Then the fourth step is we need to measure the cost of the business combination. So what is the consideration transferred? We need to find out what is the parent company paying or transferring to acquire the net assets of the subsidiary. Then step 5, we will recognize and measure any non-controlling interest in the acquiree. So here we need to determine, are we buying the whole of this company, or is there non-controlling interest? Okay, you will focus on non-controlling interest in next week's, in the lecture that will follow this lecture after the mid-semester break. So our examples don't have non-controlling interest at this stage. Then step 6 is to recognize and measure goodwill or gain from bargain purchase. So here you will compare what is the consideration paid and is it greater or less than the fair value of the net assets acquired. And then this will result in either goodwill or it will result in a bargain purchase. Okay, but we have examples on all of these. So now we have looked at the steps. Let's have a look at the acquirer. So we said that the first step was to identify the acquirer. This is known as the parent. So this is the entity that is going to obtain control over the acquiree. So what is control? How do we know if a company has control over another company? Well, basically, control is when there's power to govern the financial and operating policies of another company as to obtain benefits from its activities. Okay, so that sounds complicated, but basically a company has control over another company when it has the power, it is able to make decisions relating to the financial side of a company and the operating side of a company, and as a result of these decisions, it could obtain benefits in the way of profits. Okay, so that is how you can see whether a company has control over another company. Okay. It's not always related to the number of shares that are purchased. Sometimes it can be related to the number of directors or who is making the decisions in a company. So what are the indications, or if we are confused and not sure who the acquirer is, what can we consider? So there are certain indications that one entity is an acquirer when it is unclear. So one of the indications is that the fair value of one entity is significantly greater than that of the other. Okay, so often the acquirer will have a greater fair value than the subsidiary. Then another indication is that if the business combination is going to happen through an exchange of shares for cash or other assets, the entity giving up the cash assets is likely to be the acquirer. Then the last indication that you can consider is if the management of one entity will be able to dominate the management team of the combined entity, then that dominating entity is going to be the acquirer. Okay, so if you look at this third one here, if the management of one entity, they are able to like override the management of the other of the combined entity, then that entity that has the ability to dominate the management, that is likely to be the acquirer. Okay, so you need to consider all of these when identifying the acquirer. Sometimes it is quite easy to determine, and other times it may be more tricky. Okay, so it's important to read the information in the question. So now that we have looked at the acquirer, the next step is to look at the acquisition date. So what is the acquisition date and what is the importance of this? So the acquisition date, this is the date on which the acquirer will obtain control of the acquiree. So this is the date which the acquirer or parent company is going to transfer the purchase price, also known as the consideration paid, and they will acquire the assets and assume the liabilities of the acquiree. So there's almost an exchange on the acquisition date. The acquirer is going to transfer the purchase price, and in exchange for that, it is going to acquire the assets and liabilities of the acquiree. Then it is also the date on which goodwill is measured or a gain on bargain purchase is recognized. So on the acquisition date, once the acquirer has obtained control of the acquiree and it has transferred the purchase price and acquired the assets and liabilities, on this date it is possible to determine if there is goodwill or a gain on bargain purchase and what the amount will be. So this is the date from which the results of the acquiree are included in the consolidated financial statements of the acquirer. So from the acquisition date, we are basically adding in the results, the profits, the revenue, the expenses of the acquiree and including it in the consolidated financial statements. Okay, so that is the importance of the acquisition date. So now that we have looked at the acquisition date, we need to look at what kind of consideration can be paid or transferred. So remember we said here that on the acquisition date, the acquirer is going to transfer the purchase price to the acquiree. So now we want to have a look at what can this purchase price be made of, okay? So the consideration paid or transferred by the acquirer can consist of assets, it can consist of cash, PPE, financial instruments or other assets. There can also be an element of contingent consideration. So what is contingent consideration? Does anyone know what contingent consideration is? Okay, so contingent consideration is basically an amount that the acquirer is going to pay to the acquiree, but it is contingent upon some event that is going to happen in the future. So sometimes the agreement will say that the acquirer will pay 100,000 Rand provided the acquiree earns revenue of 2 million Rand in the next 12 months. So therefore, a portion of the consideration can be contingent on an event happening. So we then need to determine, well, how are we going to account for this? How likely is the event to happen? So those are some of the assets that can be pledged or paid by the acquirer. Also, the acquirer can assume liabilities as part of the consideration paid. So the acquirer may assume liabilities that belong to the acquiree. It may decide to take over debts and pay debts on behalf of the acquiree. There could also be other liabilities or contingent liabilities that it is going to take responsibility for. Then, so we have looked at assets and liabilities, but another form of consideration can be shares. So shares may be given to the directors of the acquiree, ordinary shares, preference shares, and options. So this can also form part of the consideration paid. So equity instruments may be issued by the acquirer to the directors of the acquiree, and that may form part of the consideration. So what we'll see when we go to the lecture examples is that often a combination of these will form part of the consideration paid. It's not always going to be just cash. It's likely going to be, it can be a combination of cash and a combination of shares, and a combination of assuming the liabilities. So it's important to read the question carefully to determine what is the consideration made of, and also to identify if there's any contingent consideration. So let's have a look at the next example. So there's just a question. So there has to be a prerequisite for contingent consideration. I'm not sure if that is what your question means, but basically they will tell you if there is contingent consideration and say that the acquirer will pay an extra 200,000 Rand if the revenue in the next 12 months is going to be set at a certain amount. So they will tell you what the requirement is for the contingent consideration, and they will also have to tell you how likely the event is that there will be how likely the event is, like there's a 70% probability that the revenue will be this in the next 12 months. Okay, so we'll have a look at some examples. So in this example here, on the 1st of January 2013, Pops Pty Limited acquired all the shares in Sunny Pty Limited from the former owners. The consideration will be settled as follows: a cash payment of 600,000 Rand, a transfer of a bakkie with a fair value of 100,000 Rand and a book value of 70,000 Rand, 1,000 Class A shares in Pops Pty Limited, and then on the 1st of January 2013, Class A shares in Pop Pty Limited were worth 15 Rand each. So we need to determine the total consideration paid. But first, let me ask you this. Okay, so the first thing you need to do is identify who is the acquirer. Who is the parent company in this situation? Is it Pops or is it Sunny? Who is the acquirer? Okay, well done. So the acquirer, also known as the parent company, is Pops Pty Limited. So remember, that is the first thing you need to do, is you need to identify who the acquirer is. In this situation, it is quite obvious who the acquirer is. And then we also need to determine what is the acquisition date in this situation. What is the acquisition date? Okay, well done. So the acquisition date is the 1st of January 2013. So it's important that you identify these two things. And now we need to ask, what is the total consideration paid? So who can tell me what is the total consideration paid by Pops for Sunny? You can just type your answer in the chat. Okay, so the total consideration, I see you're all getting it correct. It is 715,000. So if we go to the next slide and see how we calculated the total consideration paid. So remember I said it can consist of cash, it can consist of a machine, it can consist of shares. Here you can see that it is made up of more than one item. So in the scenario here, we were told that there's a cash payment of 600,000 Rand. So this is going to be part of the consideration paid, okay? So we have 600,000 Rand. Then we need to consider what is the transfer of Bucky with a fair value of 100,000 and a book value of 70,000. Now, remember we said that when we are looking at the acquisition date, your assets need to be fairly valued, okay? You need to have the fair value of your assets. So even though the book value of the Bucky is 70,000 Rand, the real market value is 100,000 Rand. So the 100,000 Rand will also form part of your consideration paid. And then if you have a look at the last item, there's going to be a transfer of 1,000 Class A shares in Pops Pty Limited. So this will be transferred to Sunny Pty Limited. And then we need to have a look at, well, what is the value of these shares on acquisition date? So on the 1st of January 2013, we're going to take 1,000 Class A shares and we're going to multiply it by 15 Rand each because this is the value of the shares on that date. So if we take all of that into account, you'll see that the total consideration paid is made up of the cash of 600,000. It's made up of the asset, which was fair valued at 100,000 Rand, and then the value of the shares being 15,000 Rand. So that gave us a total consideration of 715,000 Rand. So just take note, the consideration paid must be measured at fair value on the acquisition date. So that is why we took the fair value of the asset of 100,000 and not the book value, which was 70,000. So it is calculated as the sum of the fair values of the assets, liabilities, and equity at acquisition date. Okay. So now that we've had a look at how to calculate the total consideration paid, we need to also have a look at the journal entries in the book of the acquirer. So we are looking here at the records of the parent company being Pops. We are not looking at the consolidated financial statements yet. So this is in the books of the acquirer being Pop. So in Pop's books, they are going to, because they have now purchased Sunny, it is seen as an investment. So in Pop's books, we are going to debit our investment in Sunny Pty Limited of 715,000, and then we're going to credit the items that were used to pay for this investment. So remember, we paid 600,000 Rand in cash. So we're going to credit bank because our bank account is going down because Pop took 600,000 Rand out of the bank account and paid it over for Sunny. There was also the baki that was used to pay for the investment in Sunny. Now remember we said that at acquisition date, we need to fair value this baki. So when we have the journal entries here, we are showing that there was a gain of 30,000 Rand on the baki, which was recorded in profit and loss. So we fair valued this baki from the book value of 70,000 to 100,000. So there was a gain on the baki of 30,000. So we are recording the gain on the baki of 30,000. And then obviously we need to credit our cost account of PPE relating to the baki, which is the book value of 70,000 Rand. But the total of the book value and the gain on the baki being the 70,000 plus the 30,000, this is going to give us the fair value of 100,000. Okay, so we looked at the consideration relating to the baki being 100,000, but this can be further broken down when you do your journal entries into the amount that relates to the book value and then the gain if the fair value is higher than the book value. So we had cash of 600,000, we had the baki that was transferred, and then we also had share capital. So remember, POP issued share capital, issued 1,000 shares that were worth 15 Rand each. So they are crediting their share capital account to show the issue of these shares. Okay. So I've just mentioned this already, that the fair value of the baki must be determined on the acquisition date. So in order to do this, you compare the fair value of the baki to the carrying value, and then you determine if any profit or loss is there on transfer to be recognized by the acquirer. So before this baki is going to be used to pay for the investment in Sunny, it needs to be fair valued, and that is where the 30,000 gain comes from. Okay, so that is a simple example. From here, there are other things we need to consider now. Okay, so I mentioned contingent consideration. So when I asked this question, someone in the class mentioned that it is based on some events, like in the future, which is 100% correct. Okay, so contingent consideration. Okay, so someone is asking in this example, must you always show it separate? Okay, so ask yourself if you follow the logic of it, you can't say credit PPE baki 100,000 because the book value is 70,000. You need to fair value the baki first, which is where the gain comes from. So I would say you should show it separate because that is how the journals work. Okay. So here for contingent consideration, what is a contingent consideration? It is an obligation of the acquiring entity to transfer additional assets or equity interest to the acquiree if specified future events occur or conditions are met. Okay, so it is basically going to be an additional payment or an additional issue of shares if certain events occur. These events are usually tied to the performance, like there must be revenue of 1 million, there must be profits of 500,000. So there is some contingent events that has to happen in order for this extra amount to be paid. So the contingent consideration can be paid in cash, it can be paid in shares, it could be paid in other financial instruments or any other form, okay? And it is based on future performance factors. It is going to be based on something that is going to happen in the future, and we may not be able to determine what the outcome is, but there are probabilities involved which are going to help us, okay? And this will be in the purchase agreement, what the contingent consideration will be and what the events will be that will trigger the contingent consideration. So now that we have looked at contingent consideration, let's have a look at when we calculate this. Okay, sorry, I'm just sneezing. What is the difference between provision and contingent? Well, a provision is a liability. So a provision is a liability. I think it's just two different things here. Like contingent consideration is not always going to be a liability. So whereas a provision has met the requirements or definition of a liability, whereas contingent consideration is not always a liability. It can be classified as equity as well. So if we have a look at contingent consideration, so how do we determine the fair value of the contingent consideration? So the fair value of contingent consideration, this will be calculated on acquisition date and added to the total consideration paid or transferred. So we will need to determine what the fair value is of this contingent consideration, and we will need to include it in the total consideration paid or transferred. Like I've mentioned earlier, it can be classified either as equity if it will be settled in shares, or it could be classified as a liability if it will be settled in cash or other assets. Okay, so we will need to have a look at whether it's going to be equity or a liability, and this will determine how we're going to account for this contingent consideration. So let's have a look at an example. So on the 1st of January 2013, Pops Pty Limited acquired all shares in Sunny Pty Limited from the former owners. The consideration will be settled as followed: a cash payment of 500,000 Rand, an additional cash payment of 200,000 Rand on 31 December 2013 if turnover for the year is greater than 4 million. So can you see here that part of the consideration paid, we have a cash payment where there are no questions asked. Then we have an additional cash payment, and this will only be paid if turnover for the year is greater than 4 million. So it's obvious that this additional cash payment of 200,000, that is our contingent consideration because it is based on some events in the future. So when we have a situation like this, we need to ask ourselves, well, what is the probability of turnover being 4 million for the year? What is the percentage probability? And this is going to help us determine the fair value of the contingent consideration. So if we have a look at the next slide, they told us there we need to establish a fair value for the contingent consideration at acquisition date based on the probability of the payment. And they told us that it is 60% probable that we will earn 4 million Rand in turnover. Okay, so the probability is 60% that we will earn 4 million Rand. So how will we now determine the fair value of this contingent consideration? We will take the 200,000 Rand and we will multiply it by 60%, and this will give us 120,000 Rand. So when we calculate our total consideration paid, we will take the real cash payment, the cash payment that is not contingent, which was 500,000 Rand. This is definite. It does not depend on any events. And then we will need to take into account the additional cash payment, which was 200,000 Rand. But the probability of us meeting the target of 4 million is 60% probable. So we will then be prudent and measure the fair value at 120,000. Okay, so the probability percentage will have to be given to you, okay? It is based on judgment, so each company will be different. In real life, you would have people who would forecast, they would take last year's actuals or the last 5 years, and they will forecast what the likely revenue is going to be in the future. And then they will say, well, based on the economic conditions and the past performance of the company, this is the probability. So it's not something you will have to determine. It is based on judgment. We will always give you the probability in a question. So in this situation, the total consideration paid is 500,000 plus the 120,000 Rand, which is the contingent consideration. Now, what would our journal entries be for this scenario? So our journal entries again in the acquirer or parent company. So the acquirer has just has acquired Sunny. So we are going to go debit investment in Sunny Pty Limited of 620,000. Credit bank. So there is a cash payment, a definite cash payment of 500,000 Rand. And then we have our contingent consideration. So this is a credit, it is a financial liability of 120,000 Rand. So you'll see here that when we looked at this, we measured the financial liability at fair value at acquisition date. So in a case where a fixed payment is promised to the acquiree upon a future milestone or performance threshold, the at acquisition fair value is calculated as the fixed payment multiplied by the probability of achieving the milestone. So that is what we did. Okay, it sounds complicated, but the fair value is equal to the fixed payment, which was 200,000, multiplied by the probability of achieving the milestone, which was 60%. And that is how we determined the 120,000. We took the additional payment of 200,000 Rand and we multiplied it by 60%, and that gave us a financial liability at fair value of 120,000 Rand. Okay, so let's have a look at some other examples. Oh, well, let's just go back to our journal entries and finish that up. So we had debit investment in Sunny, credit bank, and credit financial liability. Okay, so let's have a look at this journal entry here, because this is going to now show the journal entry at the end of the year. Okay. So when we raised on acquisition date on the 1st of January, we had our investment, we debited our investment and we credited bank and we credited our financial liability. So now at the end of the year, we need to see what happens if they actually meet the 4 million Rand target. So here they're saying if Sunny's turnover for the year is greater than 4 million, then we actually need to increase or decrease the fair value of the financial liability depending on the outcome of the event. So here now Sunny has met the 4 million Rand target. So we need to then say, okay, well now we actually need to pay this amount. So previously we credited the financial liability account to raise the financial liability. So now we're going to get rid of that liability because we're actually paying that liability. So we're going to go debit financial liability, Sunny, of 120,000 Rand. But then we also need to recognize that the actual amount paid here is going to be 200,000 Rand. So there's actually going to be a fair value adjustment of 80,000 Rand that needs to be recorded. So we're going to go debit financial liability 120,000 Rand, debit our fair value adjustment of 80,000 Rand, and credit bank. So this shows that when the future event has happened, there's going to be a change in the fair value of the financial liability. And this needs to be recognized by the acquirer. In this case here, there was a fair value here of 80,000 Rand, or fair value adjustment, sorry, of 80,000 Rand, which now brings the total amount up to 200,000, which is then going to be paid out. Okay, so I hope that answers your question on what happens on the 31st of December. Okay, so someone is asking, what if the probability was 100%? Well, then it's certain. So if it's certain, then it wouldn't really be contingent consideration. Okay, contingent consideration is where there is uncertainty. If it was certain, then it's likely they wouldn't be a contingent payment. They would just pay it on acquisition date. Okay, so now we've had a look at that. Okay, so let's have a look at the next example. So that was a situation where we had cash, contingent cash, and that was recorded as a financial liability. Now we need to look at the case where there are contingent consideration in the form of shares. So on the 1st of January 2013, POPs Pty Limited acquired all the shares in Sunny Pty Limited from the former owners. The consideration will be settled as follows. There's going to be a cash payment of 400,000 Rand. There's going to be 1,000 Class A shares in POP worth 100,000 Rand. An additional 1,000 Class A shares in POP on 31 December 2013 if turnover for the year is greater than 4 million. So what is the total consideration paid in this situation here? So what is the total consideration paid for this situation here? Okay, you're right. You need the probability. So let's have a look at the next slide. Okay, you cannot really calculate the contingent consideration without the probability. So we need to establish the fair value of the contingent consideration at acquisition date based on the probability. So here they are saying there's a 60% chance that this event is going to happen. So therefore your probability is 60%. So if we then want to calculate the contingent consideration, we are going to take the cash payment of 400,000 Rand. There are no questions asked about that amount. Then there is the issue of 1,000 Class A shares in POP worth 100,000 Rand. Okay. Then there's the contingent consideration here, an additional 1,000 Class A shares in POP on 31 December 2013 if turnover for the year is greater than 4 million. So we need to ask ourselves, well, what is the value of the shares on acquisition date? They haven't given us the value per share, but there is a way we can calculate it. So we can calculate the value by share by taking 100,000 Rand for 1,000 shares and getting the value per share and then multiplying that by 1,000 shares. Okay, here it's 1,000 and 1,000. So the value of 1,000 shares is 100,000 Rand and the probability is 60%. So the contingent consideration in this case is going to be 60,000. So if we add up all of our consideration paid, we had the cash of 400,000, we had the Class A shares of 100,000, and then we had the contingent consideration, which is a possible another 100,000 shares, and the probability there was 60%. Okay, so that is the total consideration. Then we need to have a look at our journal entries. So how do we record this contingent consideration? So yes, we need to record the investment in Sunny. So remember, this is in the acquirer's books, in the parent's books. And this is basically, if you think about it, we have said we will give you 1,000 Class A shares. This is a transfer of a fixed number of shares, okay? The value of the shares may vary, but we have fixed it to a fixed number of shares. And these shares are valued at fair value at acquisition date. So we're going to go debit investment in Sunny, and then we're going to credit bank, which was 400,000 Rand. That is a definite payment. We're going to credit share capital Class A shares of 100,000 Rand. And then we have our equity contingent consideration. So here, because it is a transfer of a fixed number of shares, this contingent consideration is going to be classified as equity. So we are going to credit equity. So if we add this up, we said it was 560,000, okay? So we're going to debit investment of 560,000 at acquisition date, and here is our contingent consideration, okay? Then at the end of the year, if Sunny's turnover for the year is greater than 4 million, we are then going to issue these shares. So we're going to go debit equity contingent consideration being 60,000, and then we're going to go credit share capital Class A shares being 60,000. So here you will see that now we had that contingent consideration, and because the turnover for Sunny was greater than 4 million, the event was met, so now we can issue these shares. You'll see here that the contingent consideration or the equity in the original journal entries on acquisition date, this is measured at fair value at acquisition date. So it is recorded as equity when it is expected to be settled in a fixed number of the acquirer's shares. So contingent consideration recognized as equity is not adjusted for any changes in fair value. So when we looked at the liability, remember we had the liability, and then we calculated the probability, and then a year later, at the end of the year, we fair valued that. It is not the case here because this is expected to be settled in a fixed number of the acquirer's shares, okay? So the contingent consideration is recognized as equity, and there's not going to be an adjustment for a change in fair value, okay? It is based on the number of shares, regardless of the value. Okay, so I have answered that question. Why don't we issue at 100,000? It's because we don't adjust for the fair value, and the reason for that is because they decided on a fixed number of shares. So the fixed number of shares, the fair value at acquisition date, that is used to determine what the contingent consideration will be, and there's not going to be an adjustment to fair value. Okay. So this is the situation where we have a fixed number of shares. Now we need to look at a slightly different situation, okay? So if we have a look at the next slide, in this situation, Pop acquired all the shares in Sunny. The acquisition date is still the 1st of January 2013. There's a cash payment of 400,000 Rand. There's 1,000 Class A shares in Pop worth 100,000 Rand. There's additional Class A shares in Pop Pty Limited worth 200,000 Rand on 31 December 2013 if turnover for the year is greater than 4 million. So now you need to compare this to the previous example. In the previous example, there was a fixed number of shares that were going to be transferred. Here, they are not specifying the number of shares, but they are saying shares to the value of 200,000. So here, this is not based on a fixed number of shares. It is based on the value of 200,000 Rand. So now we need to determine what is the total consideration paid in this situation. So in the next slide, they've given us a probability of 70%. They are saying that it is likely that it is 70% probable that Sunny will make the turnover of greater than 4 million Rand. So what is our contingent consideration in this situation? So the information for the first two is the same. We have a cash payment of 400,000 Rand and we have 1,000 Class A shares, but the contingent consideration is different to the previous example. So let's have a look. They told us there we need to establish the fair value for the contingent consideration at acquisition date based on the probability. So at this stage, we are calculating the probability similarly like we did in the previous example. So the contingent consideration is 200,000 Rand, okay? They have told us there. Sorry, the value of the shares is 200,000. Then we need to multiply that by the probability being 70%. That will give us the contingent consideration of 140,000. So now we need to add together all of the consideration. Remember we had the cash of 400,000 Rand and we had the 1,000 Class A shares in POP of 100,000 Rand. And then we had our contingent consideration and we calculated the fair value of the contingent consideration at acquisition date by taking the 200,000 Rand and multiplying this by 70%. This is going to give us 140,000 contingent consideration, which will form part of the total consideration paid. So that will give us total consideration paid of 640,000. Now we need to have a look at the journal entries. Okay, so how do we account for this contingent consideration? And you'll see that because it is a transfer of shares, like a variable number of shares for a specific value, it is going to be recorded as a financial liability. It is not certain how many shares we are actually going to issue, so therefore we are going to record this as a financial liability. There is a transfer of shares, but it's based on a specific value. So you'll see here we are debiting investment in Sunny, and this should actually equal the contingent consideration of 640,000. There's a small typo there, I'll fix it and update it. So we're going to go debit investment in Sunny, 640,000, which was the total of the consideration paid. Then we're going to credit bank. Pops is paying 400,000 Rand out of their bank account to Sunny. Capital of 100,000 Rand. Then we are raising a financial liability for our contingent consideration. So it's recorded as a financial liability even though it's going to be settled in shares because it's not a fixed number of shares. We don't know yet how many shares are going to be issued. It is based on a value, and that is why we are recording it as a financial liability. So we're going credit financial liability, contingent consideration 140,000, and this was determined by taking the 200,000 and multiplying it by the probability being 70%. Now at the end of the year, Sunny's turnover is greater than 4 million. So now we need to decide what are we going to do with this financial liability. So it is recorded at fair value at acquisition date, but then we need to record it again or show any changes in fair value on the 31st of December 2013. So here now, because the event happened, we are going to pay 200,000 Rand worth of shares, okay? So we're going to go debit financial liability, contingent consideration of 140,000, and we're going to show the fair value loss of 60,000, okay, it is a debit, so it is a fair value loss, and we're going to credit share capital being 200,000. So there is an actual issue of shares, but because the number of shares is not certain, it is based on a value, we record it initially at acquisition as a financial liability. So like I mentioned previously, this contingent consideration, it is going to be it is going to be measured at fair value at acquisition date. It is recorded as a financial liability at acquisition, even though it is going to be settled in shares if the event is met. Okay. The reason is because it's not a fixed number of shares. It's a transfer of shares, but we don't know what the number of shares will be. It is a financial liability. It is based on the value. Okay, so Abdullah is asking, what if we were given number of shares? So in the previous example, we were given the number of shares, and here we are not. We are given the value, so the value of the transfer, the value of the consideration. So compare the two. In the previous example, we were told the contingent consideration would be 1,000 Class A shares, and there we recorded it as equity, whereas here it's a transfer of shares, but the number of shares is not certain. It is the transfer of shares at a specific value. So this is then going to be recorded initially as a financial liability because the number of shares is not fixed. Okay. It's basically variable in this situation. We know there's going to be an issue of shares, but we don't know how much. Okay. So that is contingent consideration in a nutshell. So we had a look at where the contingent consideration was going to be cash, and we saw that that was recorded as a financial liability, and there was a fair value loss. Then we looked at where a share issue is involved, and that is broken down into where the number of shares is fixed, and in that case it will be recorded as equity at acquisition. In this situation here, there's a transfer of shares, but it is not fixed. It is variable. It is based on a value. Okay, so in this situation, it is a financial liability, and we have the fair value loss. Okay, so someone is asking, why is there a loss of 60,000? Why is it a fair value loss? And the reason for this is that this is the records of the acquirer. So if they have a liability and the liability is getting bigger, okay, it's like the liability is getting bigger, it's bad for them, it's bad for the acquirer. So there's a fair value loss here because their liability is getting bigger, and then they canceled those two items out when they issued the shares at the value of 200,000. Okay, so someone is asking, why are we adjusting changes here? So when you have a financial liability, you need to record if there's any fair value gain or loss when that event happens. Whereas if it is equity, you don't, there is no fair value gain or loss. Okay, so have a look at those two examples. Where we have equity, where we will measure the contingent consideration as equity, and where we will measure the contingent consideration as a liability, and see how they are treated differently. If you can get this, then I'm sure everything else will be smooth sailing for you. This is probably the hardest thing in this lecture today. Okay, have a look at these examples and go over it. And if you have any questions, you're welcome to contact me. Okay, let's now go on to the next slide. So here we need to have a look at the acquisition method, or what is this acquisition thing we're talking about? What do we have to do when we have a business combination? Okay, so currently we have looked at how to record the acquisition in the acquirer's books, but now we also need to consider the consolidated financial statements and how we record that. So when we have a business combination, what do we need to do? So we need to identify all the assets that are acquired, and we also need to identify all the liabilities that are assumed by the acquirer. These assets and liabilities need to be fair valued at the acquisition date. Okay, so all these assets and liabilities at the acquisition date, we need to determine are there fair values that we need, that these assets need to be recorded at. Okay, then we need to identify any contingent liabilities and include an estimated fair value at acquisition date. So who can tell me what a contingent liability is? Who can tell me what a contingent liability is? So the contingent liability, a contingent liability is a liability that may be incurred by an entity depending on the outcome of an uncertain future event. Okay, so usually, so these liabilities are not recorded in a company's accounts. It is generally disclosed. Okay, so we need to identify any contingent liabilities and we need to include an estimated fair value at acquisition date. Similar to the previous process, we'll get a probability and say, well, what is the likely outcome of this court case, or what is the likely outcome of someone suing us? And you'll estimate a fair value from that. So where the fair value is not certain, we need to include a provisional or a preliminary estimate. So that is what we need to do when we have a business combination. That is the first thing we're going to do. So we're going to identify all assets and liabilities and determine their fair values. Then the next thing we need to do, so that is at acquisition, but what does the consolidation procedure actually involve? Okay, we are basically consolidating these two companies. So we are combining line by line items like assets, liabilities, equity, income, and expenses of the parent with those of the subsidiary. So we are combining all these items. Then if we have a situation or we need to eliminate or offset the carrying amount of the parent's investment in each subsidiary and the parent's portion of equity of each subsidiary. Okay, this sounds complicated, but basically in the parent's company, remember when we were doing those examples and in the can you guys hear me? Sorry, can you guys hear me? I think I might
Yes,
be on
ma'am, we
all.
can now, ma'am.
Can you hear me? Okay, it started buzzing there. Okay, so we need to eliminate or offset the carrying amount of the parent's investment in each subsidiary. So that investment in S now needs to be set off. So we need to credit the investment and then we need to set it off against the portion of the subsidiary share capital and retained earnings. Okay. Then based on the consideration paid and the assets and liabilities acquired, we need to recognize goodwill and a gain on a bargain purchase that may arise. So we're going to have goodwill and then we're going to have a gain on a bargain purchase. So where the subsidiary is not wholly owned by the parents, the portion owned by other shareholders is called non-controlling interest. So in this lecture, we're only looking at wholly owned. And then in the next lecture, you will have a look at the situations where there's non-controlling interest. But where the subsidiary is not wholly owned by the parent, there are other owners. The portion owned by other shareholders is called non-controlling interest, and you will need to consider this as well. Okay. So let's have a look at, let's continue with the consolidation procedures. So what is non-controlling interest? Here we're just going to introduce the idea. You will see that it's not in any of the examples, but this is just to introduce you to the idea of non-controlling interest for next week. So the non-controlling interest share of the net assets of the subsidiary is shown separately in the consolidated financial statements. So we're going to show NCI, it's usually called NCI, and it is showing that even though we have a parent and a subsidiary, the subsidiary could be owned by other owners as well. So it's just really apportioning the share of net assets that is attributable to the non-controlling interest. So these are like minority shareholders. So the non-controlling interest share of the net profit and the total comprehensive income of the subsidiary is also shown separately in the consolidated financial statements. So we also need to show that the profit here, a portion of the profit is, or the major portion will be attributable to the parent, but a small portion will be attributable to the non-controlling interest. And this needs to be shown in the consolidated financial statements. So now that we have identified the NCI, we also then need to ask ourselves, are there any intra-group assets or liabilities? So this is something like Pops has made a loan to Sunny. So in Pop's books, if Pops Pty Limited made a loan of 100,000 Rand to Sunny Limited, in Pop's books, he will show loan as an asset because Sunny owes him the money. And then in Sunny's individual records, they will record that as a liability. But when you are looking at the consolidation process, you are recording Pop and Sunny in one set of accounts. So in that case, those two actually net off. They are eliminated because you cannot show in one big company. So it's almost as if Pop and Sunny are seen as one big company. Your right hand cannot owe your left hand money because you are part of the same body. So it's a concept like that. When you have a consolidation, the consolidated company is seen as one company. So you cannot have a loan to yourself in that one company. So yes, in the individual books, there could be transactions, intra-group assets and liabilities that are recorded. But when you come together, when that company, those two companies are consolidated, those intra-group assets and liabilities need to be eliminated. Okay, we'll have a look at an example of this. There is an example of this in one of the later examples. So that is the consolidation process. Then we need to have a look at the next slide. Okay, so this is just to summarize what we've just done. So step one, we want to eliminate the cost of the investment against fairly valued equity of the acquiree. So here in the acquirer's books, you're going to have an investment and you're going to set it off against the fair value, share capital, and retained earnings of the acquiree. Okay. Then we're going to eliminate any common items and consolidation of non-common items. So this was where there were any intra-group transactions. There's a loan from Pop to Sunny. This would be eliminated. And then there's going to be a consolidation of any other items. So the PPE and S in Sunny is going to be added to the PPE of Pops. And this will give us the consolidated numbers. So in other words, we're adding 100% of the acquirer to 100% of the acquiree, which is known as B in this slide. Then we're going to eliminate the cost of the investment and make certain standard adjustments to other common items. Okay, it sounds complicated, but let's have a look at an example. Okay, so we have Alpha Pty Limited. They bought 100% of the share capital in Sunny Pty Limited on the 1st of January 2013 for 1.2 million. The respective statement of financial position of the two companies are as follows. So let's have a look at the statement. So they told us they Alpha and Sunny, and they showed us all of the assets and liabilities. So Alpha has 1.6 million PPE, Sunny has 890, and they told us here that Alpha has an investment in subsidiary of 1.2 million. And you will see here that Sunny has share capital of 400,000 and retained earnings of 800,000. Okay, so let's see what we have to do now. What do we have to do with these figures? So we are going to go through the consolidation process. So remember, step one was to eliminate the investment in Sunny against fairly valued equity of Sunny. Okay, this sounds confusing, but remember in the acquirer's books, in Alpha's books, it had an investment of 1.2 million investment in Sunny. And this needs to be set off against the share capital and retained earnings in Sunny's books. So Sunny's equity consists of share capital of 400,000 and retained earnings of 800,000. So the investment in S in Alpha's books can be set off in the consolidated financial statements to the share capital and retained earnings in Sunny's books. So let's have a look at the journal entries. So in Alpha, there's an investment in S of 1.2 million. And then in Sunny, there's equity share capital of 400,000 and retained earnings of 800,000. So in order to eliminate these items, we prepare what we call pro forma journal entries. So let's have a look at the pro forma journal entries. Okay, so just to tell you something, because it can be confusing, but you need to know that Alpha will prepare its own financial statements and Sunny will prepare its own financial statements. But in the consolidated financial statements, this is where the pro forma journal entries will appear. So these pro forma journal entries, they will not appear in the books of Alpha and they will not appear in the books of Sunny. They will only appear in the consolidated financial statements. So they are done as part of the consolidation procedure at the end of the year in order to prepare the consolidated financial statements. Okay, so just ask yourself, in whose financial statements are you recording these items? So if you go back to the statement of financial position, so this shows Alpha as a company, all of the figures, and this one shows Sunny. So Alpha has an investment in subsidiary Sunny of 1.2 million. That is going to be set off the equity in Sunny of 400,000 share capital and retained earnings of 800,000. So let's have a look now at the actual pro forma journal entry. Okay, we've had a look at these slides. We had a look at what a pro forma journal entry is. Now we need to show, so if I ask you what are the pro forma journal entries to eliminate the investment in Sunny and Sunny Limited's equity, okay, usually it'll just say what are the pro forma journal entries. There you will go debit share capital 400,000, debit retained earnings 800,000, credit investment in S Limited 1.2 million. So we are basically eliminating the parent's investment in the subsidiary. It was a debit in the acquirer's books, now it is a credit. And we are eliminating that against the share capital and retained earnings in Sunny's books. We eliminate the parent's investment in its subsidiary on consolidation because the consolidated financial statements show the group. Okay, so in the consolidated financial statements, we're showing both Alpha and Sunny. But then if we're showing both Alpha and Sunny, we cannot have an investment to Sunny in the consolidated financial statements, which is why we do the pro forma journal entries here. Okay, so that is the pro forma journal entry that we use to eliminate the parent's investment in its subsidiary on consolidation, because the consolidated financial statements show the group. Okay, now we can have a look at the consolidated statement of financial position. So remember, previously I showed you A limited and S limited. Now have a look at this consolidated comment here, the consolidated column here. So PPE in A limited had 1.65 million. S limited had PPE of 890,000. We added A plus S, and that gave us PPE in the consolidated financial statements of 2,540,500 rand. Now look, we had investments in Sunny of 1.2 million. We cannot have that in the consolidated financial statements because we're going A plus S, but then this is the consolidated financial statements of A and S. So this is going to be the pro forma journal entry. So PFJE stands for pro forma journal entry. Okay, so we'll carry on with these examples and we'll see where there's goodwill and a gain on bargain purchase, how that is recorded. So have a look also here. Inventory A had 450,000. S had 167,500. So A plus S, if you add the inventory for both of those, that is going to give us 617,500. Then we have trade receivables of 880,500 plus S, 86,000 trade receivables. If we add A plus S, that is going to give us 966,500. And it's the same with bank. We're going to take A's bank of 78,400 and the bank of S of 66,800. And that is going to give us a consolidated bank of 145,200. Then we have a look at the share capital. So A has share capital of 1 million. S has share capital of 400,000. But we are setting off the investment in Sunny with the share capital of Sunny. So the share capital will be A plus S minus S, which is 1 million. And then for our retained earnings, we are setting off the investment to the retained earnings of S. So it is 1,680,000 plus 800,000 minus 800,000. That will give us 1,680. Okay. And it's the same with the long-term loans, A plus S. S doesn't have anything, so it's 750,000. Trade payables, we're adding the trade payables of A and S, and the consolidated trade payables is 189,700. Okay, so that shows the consolidated statement of financial position. Now, this was assuming there was no goodwill or gain on bargain purchase, but in reality, there will be a gain on bargain purchase or goodwill. So let's have a look at the three scenarios which we can encounter. Okay, so there's three scenarios. The first scenario is where the shares acquired at acquisition date are acquired at a consideration equal to the fair value of the net assets of the subsidiary. So if the consideration paid is equal to the fair value of the net assets acquired, this is referred to as an acquisition of shares at fair value of the identifiable assets and liabilities of the acquiree. So in this case, there would be no gain on bargain purchase or no goodwill, okay? Because in this scenario here, the shares are acquired at consideration equal to the fair value of the net assets of the subsidiary. So it is only where these two differ that goodwill or gain on bargain purchase will result. Then if you have a look at the second scenario, where the shares are acquired at acquisition date and they are acquired at a consideration greater than the fair value of the net assets of the subsidiary, this is referred to as an acquisition of shares at a premium, and as a result of this, goodwill will need to be recognized in the group financial statements. So this means that the consideration paid is greater than the fair value of the net assets that we are getting. So if we are paying more than what we are receiving, then we are basically saying that we need to account for goodwill. There are going to be like benefits that we recognize as a result of these two companies coming together. The sum of the parts is greater. Basically the consolidated company will have certain advantages to the two companies operating separately. But basically there's going to be something called synergistic benefits, and this is recorded in the financial statements as goodwill, okay? Then if we have a look at goodwill in more detail, so goodwill arises when the investor pays more for its investment than the fair value of the identifiable assets acquired and liabilities assumed. So the investor is paying more than what the assets and liabilities are worth. So the excess is going to be attributed to, or the excess, if you can allocate it to specific assets that you are acquiring, then it should be allocated to those assets. But if the excess cannot be allocated to specific assets, it is considered to represent an intangible asset called goodwill. Okay, so in most cases where we are paying more, where the acquirer is paying more than the fair value of the assets and liabilities acquired, this is going to result in goodwill. So where is goodwill recognized in the financial statements? This is going to be recognized as a non-current asset in the group's annual financial statements. It represents the future economic benefits arising from the acquisition of the investment in the subsidiary. So it basically says, well, I'm willing to pay more for these assets than their fair value, because in the future, I know these assets will be used to generate a huge profit. Therefore, I'm willing to pay more, and therefore goodwill will result. So for a wholly owned subsidiary, the goodwill can be measured as the consideration paid less the fair value of the net assets acquired. So that is goodwill. We will have a look at an example of this. So where there is 100% acquisition of a subsidiary, so this is where there is a wholly owned subsidiary, the goodwill is recognized in the group's annual financial statements if the sum of the consideration paid plus any previously held equity is greater than the fair value of the net assets. Okay, so we've said this. How do we calculate goodwill? When does it result? It happens when you are paying more than what you are actually getting. So the consideration paid is more than the fair value of the identifiable assets acquired. Okay, so that is goodwill. The next scenario is known as a gain on bargain purchase. So this is almost opposite to the goodwill situation. So where the shares are acquired at acquisition date and they are acquired at a consideration less than the fair value of the net assets of the subsidiary, this is referred to as an acquisition of shares at a discount. This acquisition at a discount is going to result in a gain from bargain purchase in the group financial statements. So here we are getting assets that maybe have a fair value of 100,000 and we are only paying 80,000 for them. So we are almost getting something that has a greater fair value and we are paying less for it. So if this is the situation, we have something that is called a gain on bargain purchase, and this is the opposite of goodwill, and this needs to be recorded in the group's financial statements. Okay, so let's just have a look at the gain on bargain purchase. So the gain on bargain purchase will result where we are paying less than the fair value of the net assets. So it's almost like you go to Checkers and they're having a sale, something that was valued at 100 Rand, maybe it's chocolate. The Ferrero Rocher was valued at 100 Rand, but you are getting it for 50 Rand. So that is the situation where you have a gain from bargain purchase. It's a bargain purchase. You are getting something that is valued at 100 Rand. You are getting it for 50 Rand. So therefore, you'll have a gain from bargain purchase. So here it just says where the parent acquires 100% of the shares in a subsidiary, where they are acquiring those shares at less than the fair value of the identifiable net assets of the subsidiary, the parent is considered to have made a gain on bargain purchase. So they are getting the assets, and this is worth more than what the acquirer is paying for those shares. So this may sometimes happen when a subsidiary is not in a strong position. Maybe they are somehow performing poorly, or the economic conditions are very difficult in that country. There could also be a forced sale, or where there is a significant contingent liability that hasn't been realized yet. Okay. So it is possible to have a gain from bargain purchase, but I suppose the acquirer would have to be cautious and ask itself, well, is there a reason why I'm able to acquire these shares for less than the net assets and liabilities? There's sometimes a reason. Sometimes there could be a contingent liability. Sometimes it could be a forced sale. Maybe the company doesn't have enough cash flow and they are forced to sell to somehow survive. Okay, so that is a gain on bargain purchase. Okay, so this just reiterates what I've said. What is a gain from bargain purchase? This is when the consideration paid is less than the fair value of the identifiable net assets of the subsidiary. So we are paying something, we are paying less than the fair value of the assets, than the net assets than which we are acquiring. So this gain is a credit, and it is recognized in the group's consolidated financial statements directly in the group's profit or loss on acquisition date. So this will result in an increase in the group's equity at acquisition date. So the gain from bargain purchase, where is it recognized in the group's annual financial statements? So the consideration paid plus any previously held equity interest at fair value is less than the fair value of the identifiable net assets acquired. Okay, these slides are a bit repetitive. We are basically just saying where does a gain from bargain purchase arise? It is going to arise and be recorded in the financial statements if the consideration paid plus any previously held equity is less than the fair value of the identifiable net assets acquired at acquisition date. Okay, so always compare your consideration paid to your identifiable net assets. Where your consideration paid is less than your identifiable net assets, you have a gain from bargain purchase. Where your consideration paid is greater than your identifiable net assets, you have goodwill. So where's the gain from bargain purchase recognized? It is going to be recognized in the group's profit or loss, which means it will affect the group's retained earnings from date of acquisition. So it is going to be recorded in the profit or loss, and then it is going to be recorded in the retained earnings. Obviously, your retained earnings is like your opening balance retained earnings plus your profit for the year, and that will give you your retained earnings. So therefore, if your gain from bargain purchase is recognized in the group's financial statements, it is going to affect your retained earnings. Okay. Let's go through an example, and this will assist us in understanding these situations. So P Limited acquired all the shares in S Limited on 31 December 2012. The consideration paid was 89,000, and the assets and liabilities of SPTY Limited were considered to be fairly valued on this date. The condensed statements of financial position of the two companies at 31 December 2012 were as follows. So here we have P Limited and S Limited. So that is just showing their separate financial statements. Okay, but obviously in the consolidation process, we are going to take these financial statements and we are going to consolidate them. So let's have a look at first the analysis of the owner's equity of S Limited. So here in the trial balance, we have share capital of 80,000 in S Limited, and we have retained earnings of 9,000. So if we go to the next slide, this is the analysis of owner's equity of S Limited. So at acquisition date, we have share capital Class A shares of 80,000, and we have retained earnings of 9,000. So we have total equity of 89,000 Rand, and the consideration paid was 89,000 Rand in this situation. So in this situation now, we need to discuss what are our pro forma journal entries going to be. So if we have a look at this situation, we need to decide what are our pro forma journal entries going to be. So remember, our pro forma journal entries, we basically need to eliminate the investment in S to the share capital and the retained earnings. So in S's books, S had share capital of 80,000 and retained earnings of 9,000. And we are going to set this off against the investment in S. So we're going in the pro forma journal entry. So these journal entries are only recorded in the consolidated financial statements. So we're going to go debit share capital 80,000, debit retained earnings 9,000, credit investment in S 89,000. So in this situation, is there going to be goodwill or a gain from bargain purchase? In this situation, is there going to be a gain from bargain purchase or goodwill? Okay, because an acquisition of shares at the fair value of the identifiable assets and liabilities of the acquiree, we're basically saying that the consideration paid was equal to the fair value of the identifiable net assets. So in this situation, there is no goodwill or no gain from bargain purchase. So that is why in these pro forma journal entries, you won't see goodwill or gain from bargain purchase. So if I ask you then to prepare the consolidated statement of financial position, how are we going to do it? So we eliminated the investment in S against the share capital and retained earnings of S. Now we need to prepare consolidated financial statements. So we're going to take PPE in P Limited and PPE in S Limited. We're going to go 91,000 plus 65,000. That will give us consolidated PPE of 156,000. Then we're going to go investment in S Limited. P Limited had this investment in S Limited, but in the consolidated financial statements, this was eliminated because we are preparing the consolidated financial statements here. Then when we get to trade receivables, we'll go trade receivables 48,000 plus 44,000. That will give us consolidated trade receivables of 92,000. Then we have total assets. Okay, so the total assets here, you'll just add up. When we look at share capital, we'll say our P Limited share capital plus our S Limited share capital, but then remember the share capital in S Limited was eliminated. So that'll give us share capital of 200,000. Then we have retained earnings, 8,000 plus 9,000, but then we had the pro forma journal entry of 9,000. So in our consolidated records, we just have 8,000. Then under liabilities, under long-term loans, we have 20,000 P Limited plus 20,000 S Limited. So we go 20,000 plus 20,000. In our consolidated records, that will give us 40,000. Okay, so this column represents our consolidated statement of financial position. Okay, so it's not that difficult once you go through all the steps. You have to just do it systematically, okay? You need to add all of the assets and liabilities in P Limited to all the assets and liabilities in S Limited. And then remember your pro forma journal entries. This is going to impact some of the line items in your consolidated statement of financial position. So let's have a look at the next example. So here we have a consolidated statement of profit or loss and other comprehensive income. Acquisition date 31 December 2011. For year ended 31 December 2011, consolidated statement of profit or loss and other comprehensive income equals 100% P Limited only. Hold on now. Let's just see if this is for the previous example. Okay, so this is just for the previous example here. Okay, let's go to the next example. Oh, so this is just explaining the consolidated statement of changes in equity and the statement of profit or loss relating to that example there. Okay, so let's go ahead to the next example. We're just running out of time a bit. So in example 7, here we have P Limited acquired 100% of the equity of S Limited on 31 December 2012. On this date, P Pty Limited paid a consideration of 95,000 and the assets and liabilities of SPTY Limited were considered to be fairly valued. So the condensed statement of financial position of the two companies at 31 December 2012 were as follows. Okay, so let's have a look at the statement of financial position for the two companies. So here you'll see P Limited has the PPE, it has all of its assets, equity and liabilities, and S Limited has the same. So they have given us the statement of financial position of the two companies. Then they have shown us the owner's equity of S Limited. So this is similar to the previous example. S Limited has share capital of 80,000 and retained earnings of 9,000 Rand. But how much was actually paid for this equity? 95,000 Rand was paid. So when we consider where there is goodwill or gain from bargain purchase, we'll see that the consideration paid was 95,000 Rand, and we are paying for the net assets of 89,000 Rand. So therefore, we have goodwill of 6,000 Rand in this situation here. So remember in the previous example, the consideration paid equaled the net assets. There was no goodwill or gain from bargain purchase. Whereas here, we have consideration of 95,000 Rand, which is greater than the net assets of 89,000. So this therefore results in goodwill of 6,000 Rand. Now, what are our journal entries? What are our pro forma journal entries in this situation? So remember we had those steps that we looked at. Step 1 was to eliminate investment in SPTY Limited against SPTY Limited's fairly valued equity. So here we are going debit share capital. So S Limited would have credited share capital. We are eliminating that by going debit share capital. In S Limited's books, they would have had a credit of retained earnings of 9,000 Rand. But we are eliminating this. So we are going debit retained earnings, 9,000 Rand. Then we have a credit investment. How much was paid for S Limited? 95,000 Rand was paid. And the difference between this 95,000 Rand and the net assets of S is goodwill of 6,000 Rand. So this is known as an acquisition at a premium, and the premium is recognized in the consolidated statement of financial position as goodwill. So this is a situation where there is goodwill. Let's have a look at the statement of financial position so we can see how this changes. So to calculate our consolidated statement of financial position, remember we take P Limited statement of financial position and we have S Limited statement of financial position. So we're going to take the PPE of P Limited plus the PPE of S Limited. That will give us a consolidated PPE of 156,000. Then we have our investments in subsidiaries. In P Limited's book, it had investment of 95,000 Rand. But remember, so this investment would have been an asset, it would have been a debit. But in that pro forma journal entry, we credited the investment to show that in the consolidated financial statements, we cannot have this investment in subsidiary. So we eliminated this investment in the subsidiary. Then we also calculated goodwill of 6,000 Rand. So this goodwill would not appear in P Limited or S Limited separate financial statements, but it would be in the consolidated financial statements. So we have the 6,000 Rand here, goodwill. This is a non-current asset. Then we have trade receivables of 42,000 in P Limited's book and trade receivables of 44,000 in S Limited's book. So 42 plus 44 will give us 86,000. So then if we look at the share capital, in P Limited's book, we had 200,000 Rand worth of share capital. S Limited had 80,000 Rand in its own books. Remember, we processed that pro forma journal entry. So we debited share capital in the pro forma journal entry. That would have eliminated the 80,000 Rand in S Limited's books. So the consolidated share capital is 200,000. Then we have retained earnings. In P Limited's book, we had 8,000 Rand of retained earnings. S Limited had 9,000 Rand. So we go P plus S, but then we also need to consider the pro forma journal entry. So this retained earnings would have been a credit in S Limited's books, but remember we processed the pro forma journal entry of 9,000 Rand. So that would eliminate the retained earnings in S Limited's book. So we go 8 plus 9 minus 9. That will give us consolidated retained earnings of 8,000. Then we have long-term loans of 20,000. We'll go P Limited 20 plus S Limited has 20. That will give us a consolidated figure of 40,000. Okay, so that is the consolidated statement of financial position. So that was example 7, where we had goodwill. Let's have a look at example 8 and see if the scenario is different and how they account for it. So in example 8 here, we have P Pty Limited. They acquired 100% of the equity of S Pty Limited on 31 December 2012. On this date, P Pty Limited paid a consideration of 75,000, and the assets and liabilities of S Pty Limited were considered to be fairly valued. The condensed statements of financial position of the two companies at 31 December 2012 were as follows. So here they give us all the assets, equity and liabilities. So here you'll see we have a column for P Limited. That is the assets, liabilities, and equity in its separate statements. Then we have S Limited, which has assets, liabilities, and equity in its own statement. So now we need to consolidate these two companies. So let's have a look. In S Limited, it had share capital. S Limited had share capital of 80,000 Rand and retained earnings of 9,000 Rand. If we total that, we get 89,000 Rand. But the consideration paid is 75,000 Rand. So is this goodwill or a gain from bargain purchase? So because the consideration we are paying is 75,000 Rand, this is less than the net assets of S Limited. So because we are paying 75,000 Rand for net assets of 89,000 Rand, the difference needs to be recorded as a gain from bargain purchase. So what are our pro forma journal entries in this situation? So remember, our first step was to record our pro forma journal entries. So in S's books, they had share capital, a credit of share capital of 80,000. We need to eliminate that. So we are going to go debit share capital in our pro forma journal entries. Remember, these pro forma journal entries will only appear in the consolidated group. Okay, these pro forma journal entries will not appear in the separate books of S or P. They are only in the consolidated financial statements. So then S Limited had a credit of retained earnings of 9,000 Rand. We need to eliminate that. So we are going to go debit retained earnings 9,000 Rand. Then investment in S, how much was paid for S Limited? So P Limited paid 75,000 Rand for S Limited. In P Limited's books, they had an investment of 75,000 Rand over here. So in P Limited's book, they had an investment of 75,000 Rand. But in the consolidated financial statements, we cannot have that. So we performed the pro forma journal entry to eliminate that investment. It was a debit in P Limited's books, so we are crediting the investment with 75,000 Rand. So the difference between these items is 14,000 Rand. This represents the gain on bargain purchase. Okay, so the gain from bargain purchase is not a non-current liability. When I meant it was the opposite to goodwill, it's the opposite situation, okay? But the gain from bargain purchase is going to be recorded in your profits, and then it will make its way to retained earnings in your equity. So it's the opposite situation. When you have goodwill, your consideration is greater than your net assets that you're acquiring. This is opposite to the gain from bargain purchase. When you have the gain from bargain purchase, your consideration paid is less than your net assets acquired. So that is how it is opposite. But your gain from bargain purchase will be recorded in your statement of profit or loss. And then because it's in your statement of profit or loss, it will filter through to retained earnings. So where we have a situation here where we have a gain from bargain purchase, it is said to be an acquisition of shares at a discount. So the discount results in the recognition of a gain from bargain purchase in the group's financial statements. So let's now have a look. We've done our pro forma journal entries. So now we need to show our consolidated statement of financial position. So in our consolidated statement of financial position, we have property, plant and equipment 91,000 plus 65,000 in S. Consolidated, that will give us 156,000. Then we have investment in S of 75,000 plus S limited. And then remember, our pro forma journal entry will be here to eliminate our investment in P. So we go 75 plus 0 minus 75 equals 0. Then we have trade receivables of 62,000 plus 44,000 in S. So we'll go 62 plus 44. That'll give us 106,000. Then we have share capital. So the share capital in P Limited is 200,000 plus the share capital in S of 80,000. But remember, we had the pro forma journal entry to eliminate the share capital. So it's 200 plus 80 minus 80 will give us 200,000. Then we had our retained earnings. We have 8,000 plus 9,000. But remember, we had the pro forma journal entry of 9,000 Rand. And then our gain from bargain purchase will be added to our retained earnings through our profit. So our retained earnings in this situation is 22,000. Then we have our long-term loans. P Limited had long-term loans of 20,000. S also had 20,000. So 20 plus 20 will give you 40. So if we go, so here, this might confuse you, but I told you that the gain from it's going to be recorded in your net profit. So your net profit will increase by 14,000 Rand for the year ended 31 December 2012. In the consolidated statement of profit or loss and other comprehensive income. So it may be confusing because I told you that it's recognized in net profit, which is true, but remember your retained earnings includes your current year profit. So that is why the 14,000 Rand gets included in the 22,000 Rand. Okay. So this slide just explains that here. The net profit will increase by 14,000 Rand in the statement of profit or loss and other comprehensive income. For the year ended 31 December 2012, the consolidated statement of changes in equity will show an increase in retained earnings of 14,000 Rand. For year ended 31 December 2011, the consolidated statement of changes in equity will equal 100% P Limited plus the gain from bargain purchase. Okay, so the acquisition date was the 31st of December 2012. So if we look at the consolidated statement of changes in equity before that date, it will only consist of P Limited, okay? plus the gain from bargain purchase. So that is it from me. That shows the situation. We had a look at consideration paid, and we had a look at who is the acquirer and the acquisition date. And we had a look at the pro forma journal entries. So that is the end of this lecture. The next lecture will be after the mid-semester break, and that will involve at acquisition for partially owned companies. Okay, so that is it from me. Let me stop